Central bankers are starting to get a little panicky, rushing their rate cuts over rising unemployment and prospects for a lot more of it. I said right here on this channel in early July that a July rate cut was in play because of how much the economy and labor market had deteriorated, and that even the sticky CPI central bankers at the Fed would have to seriously consider cutting rates at last month's meeting. And when I said that, the notion seemed silly, outlandish. The economy was fine, if not too fine. The labor market was booming, at least according to the pre-revised payroll figures. Turns out, I was right about the labor market and the Fed. How much perception, not the economy, mind you, just perception of the economy, how much they have changed in a relatively short period of time. The FOMC minutes for last month's meeting, which were released just yesterday, they confirm several participants expressed that a, quote, plausible case had been made supporting a July cut and that they would have voted for it had one been proposed. Now, this is not a positive sign. Since central bank rate cuts aren't stimulus, they're another confirmation that recession has already started or is about to. And this is true in every cycle and around the world, not just in the US. Rate cuts are no good. The fact is established by both history of recessions as well as the recent data, which continues to point to around March and April as the increasingly likely inflection point. So a July rate cut would have been perfectly consistent with the historical pattern where the Fed begins acting toward the beginning of the full-blown downturn. Either way, the July minutes all but guarantee September is going to be the start for what by now almost certainly doesn't matter. And the Fed is hardly the only central bank. There are a whole bunch of them all out there beginning to rush more cuts out the door. When the official sector begins to panic, you know it's already too late. And the reason it's too late because we keep coming back to over and over again March and April as the inflection. While everyone was all over sticky CPIs and sticky inflation and higher for longer and all that, it turns out the economy turned the other way. And the reason why central bankers have to panic into rate cuts is because, once again, they choose to highlight the wrong risk. But as we're seeing more and more lately, it's no longer just a risk. Now, I've been saying since last year that there was an inflection in the economy that put us on this path toward where we are today. Around September and October, a whole bunch of data, especially in the labor market, the household survey, the unemployment rate, the labor force, and a bunch of other JOLTS hiring, all of it suggested that the economy may have tipped into at least half a recession, the hiring freeze part of it, way back last October. And the updated payroll report, the revisions that are going to be made because of the QCEW, they suggest that the inflection might have happened as early as last July. Whatever the case may be, the half recession may have begun last October. More and more we're seeing that the full recession may have started around March and April, as I said. Not only do we have JOLTS and jobless claims to a degree, there was consumer confidence, which just absolutely plunged since March. And that was not about consumer prices. And as I mentioned in a recent video and I showed the data, consumer confidence correlates pretty strongly with not just unemployment, but future unemployment. Consumer confidence, according to the University of Michigan survey, suggests the unemployment rate over the next 12 months is at least 7%, if not higher. And then there's the unemployment rate itself. It was meandering higher, as is the historical pattern, for well over a year until around March and April when it started to move more decisively upward, triggering the SOM rule, which got many of the professional economists and central bankers worried because here they had a quantitative rule that they look at, which all but says there's a recession happening here. And that's another thing that's likely triggered the discussion back in the July FOMC meeting, as well as ongoing discussions throughout the media and economy and everywhere else, is that we're getting more quantitative measures that blaring recession signals and warnings as well. I talked about the beverage curve and how that suggests that unemployment might be ready to surge from here as well. There's a couple of researchers from the University of California system who took the basic concepts of the beverage curve and came up with a two-sided rule that has predicted recessions, or at least back-tested for recessions, going back to 1930. And when I say two-sided rule, what I mean is it eliminates all the false positives, where you call for a recession that doesn't end up happening, as well as eliminating all the false negatives, where you miss a recession that doesn't happen, that doesn't get captured in the signal. And their recession indicator starts with the SOM rule, which is basically labor supply. But by using the SOM rule, they're actually looking at the momentum of unemployment in the economy. And then the other side of that, they use the vacancy rate or job openings, which is, again, the Beveridge curve. The Beveridge curve put those two together. But they take the vacancy rate and also convert it into a momentum indicator. So they're looking at labor demand and labor supply as the Beveridge curve does, but in a momentum perspective. And when they see both of those begin to move more assertively and more decisively, then they say it triggers the recession, or at least it triggers the recession confirmation. When our indicator reaches 0.3, a recession may have started. When the indicator reaches 0.8, a recession has started for sure. This new rule is triggered earlier than the SOM rule. On average, it detects recessions 1.4 months after they have started, while the SOM rule detects them 2.6 months after they're started, because these are not real-time indicators, they're slightly lagging. The new rule also has a better historical track record. It perfectly identifies all recessions since 1930, while the SOM rule breaks down before 1960. And given all of that, where we stand right now, they say, with the July 2024 data, our indicator is at 0.5. So the probability that the U.S. economy is now in recession is, according to their rule, 40%. In fact, they say, the recession may have started as early as March 2024. So even these quantitative indicators go back to around March and April as well. So that's what I keep saying, is that we keep seeing confirmation in all these various places, whether it be quantitative rules like SOM or this one here from the fellows in California, and on top of macroeconomic data like consumer confidence and the labor data itself, along with corporate reports. How many of those have we had over this same period in time where companies keep saying, our consumers have no money, macroeconomic uncertainty. They love to use that term, which is just a euphemism for recession signals that we're talking about here. We keep getting them everywhere. And behind everything, of course, the markets, which have been pricing this very scenario from the very beginning. And more the evidence continues to move in that direction, so that by the time we got to July, when specifically what I made that video on, the ISM report comes out and suggests that the economy had indeed moved solidly into recession territory, not just in manufacturing, but more importantly in services, and more importantly than that, it had finally managed to pierce the labor market. So here's what I said on July 3rd. The U.S. economy is showing clear signs of deepening trouble. So much that it might even flip the Fed to start cutting rates at the end of this month. Now, policymakers have pledged to be patient, but that was only so long as they could plausibly pretend everything was strong and resilient. As I keep saying, it all comes down to jobs. As it turned out, Powell and the FOMC were not able to dismiss and ignore these recession signals any longer. Because according to the FOMC minutes that were released yesterday for that very meeting, well, nobody thought the Fed was going to cut rates. Nobody seriously thought the Fed was going to cut rates at its last meeting. They considered cutting rates. In fact, not only did they consider cutting rates, they put it in the minutes for that very meeting. Here's what the text says. All participants supported maintaining the target range for the federal funds rate at 5.25% to 5.5%, although several observed that the recent progress on inflation and increases in the unemployment rate had provided a plausible case for reducing the target range 25 basis points at this meeting. This is the July meeting, or that they could have supported such a decision had one actually been proposed. So what they're saying basically is that they regret that they didn't do it, and they're putting this in the meeting minutes knowing that the financial media is going to pick up on it. Because the next best thing for a central banker is, if you can't cut rates, or because the ultra hawks were in the way and they're not confident over sticky inflation that completely disappeared during the same window, the next best thing is to at least announce that you might announce a rate cut in the future. And that's exactly what they're doing here. They're saying that we see the weakness too, though we're going to pretend it's not all that bad, it's not all that weak. We're just cutting rates out of an overabundance of caution. Not only that, they were also bailing on the establishment survey, the payroll number that they had been relying exclusively on to say the economy's just fine, strong and resilient and all that. Well, the QCEW put that to rest, and the Federal Reserve actually talked about it, and that shows up in the meeting minutes as well. The monthly pace of payroll job gains had moderated from the first quarter, but had been solid in recent months. However, many participants noted that reported payroll gains might be overstated. Of course, we know that they really are. And several assessed that payroll gains may be lower than those needed to keep the unemployment rate constant with a flat labor force participation rate. The very thing that I continue to point out here. Participants observed that other indicators also pointed to easing in the labor market conditions, including a lower hiring rate, not lower hiring rate, a crashing hiring rate, and a downtrend in job vacancies since the beginning of the year. Therefore, you've got basically all the ingredients of everything that we're talking about. The Fed had said payroll reports look really good, so we're not worried about the economy. And then everything else started to look really bad. And they said, well, the payroll reports still look really good, but now they can't even say that anymore because we know the payroll reports are overstated. And even if they aren't negative themselves, as the FOMC minutes say, it's not enough to keep the unemployment rate from rising. And once the unemployment rate starts rising, it triggers all sorts of bad second and third order effects that we call recession. Since they're now all kicking themselves that they backed the wrong risk, they backed the wrong horse, the inflation horse, they caved into the inflationists on the committee last month, instead of cutting rates like they probably wish they had, they're basically guaranteeing that they're going to start cutting rates in September. The minutes also said, and note the word here, the vast majority observed that if the data continued to come in about as expected, it would likely be appropriate to ease policy at the next meeting. So basically they're saying, vast majority, we screwed up. We're sorry we didn't cut in July. We want everybody to know that we probably would have cut in July if not for these inflation hawk people. Instead, we're going to do it in September, all but guaranteed. Data dependence is thrown out the window. Who cares what the consumer price index is? It's now all about unemployment because it's already likely too late. The Fed, of course, is not the only central bank that is now kicking themselves. The Riksbank over in Sweden has already cut rates twice, but what's noteworthy about that is they keep cutting rates and saying we're going to do even more as we go through. Back in April, the policymakers in Sweden announced that they were going to cut once in May, and then maybe there would be two more in the second half of this year. Then we get to June in Sweden, and they held rates. They didn't cut again, but then they forecast, well, maybe 2 or 3 more cuts for the rest of the year because the economy looked like it was picking up in the first quarter, and then it suffered a pretty severe setback in the second quarter. In fact, the Riksbank governor, Mr. Theden, said, we have entered a new phase for monetary policy as inflation has subsided and the economy is weak. So in June, they've got 1 rate cut and now forecasting 2 or 3 more. Fast forward to August, just a couple days ago, and Riksbank cut again. So that's their second rate cut. And now they're forecasting as many as 3 more. So we started out in April with 1 cut plus 2 more. Then we went to 1 cut plus maybe 3 more, to then 2 cuts plus maybe 3 more. So we went from 3 to 4 to 5 in a matter of just months. That's just Sweden. Over in Europe, the European Central Bank. The European Central Bank cut rates in June, despite the fact that their consumer price pledge had not been met, as I talked about a couple months ago. They said, we are not going to rest until the consumer price numbers are right back on target. Instead, consumer price numbers in Europe have actually become very sticky. The headline HICP has been sideways for about 8, 9, 10 months with no progress in the annual rate and very little progress in the monthly rates. It didn't matter. The ECB cut rates anyway because they were worried about the economy. And now the no progress on the consumer prices in the latest data, they're saying we're going to cut rates again in September and probably thereafter as well. The head of the Bank of Finland, Olli Rehn, was in New York just recently, a couple days ago, and he said, in my view, the recent increase in negative growth risk in the euro area has reinforced the case for a rate cut at the next ECB monetary policy meeting in September. And he said, provided that disinflation is indeed on track, if they're data dependent looking backwards at the HICP, it is not on track. But of course, it will be in track in reality, but by their own terms, they're violating their own pledge. And Rehn followed that up with, meanwhile, the bad news relates to the growth outlook. There are no clear signs of a pickup in the manufacturing sector, even though the energy cost drivers of the weak performance seem to have largely faded away because it wasn't energy cost drivers. The weak performance is simply a reflection of the weak global economy, Europe included. Europe was supposed to be recovering this year, and instead it's becoming very clear that the risks are, forget the recovery's gone. The risks are that the recession gets worse, a lot worse this year, which was supposed to have been recovery. In fact, even mainstream economists are seeing the same thing. Here's Deutsche Bank's Robin Winkler, who said, the German economy specifically has completely run out of steam over the summer. The question for the rest of the year is no longer when recovery will come, but whether a renewed recession can be avoided. It will probably amount to a year of stagnation. And that's what all of these rate cuts are hoping for. Now, they believe rate cuts are effective, and therefore, if we do some rate cuts, we can at least limit the downside to at worst stagnation. When in reality, all the rate cuts signal is that the policymakers finally realized they were wrong about inflation and consumer prices, and they should have been more concerned about economic weakness and especially unemployment. And history shows, as does common sense, that rate cuts don't help. And not only do rate cuts not help, the only way they do help is by signaling the start of recession. When policymakers who always look in the wrong way finally realize their mistake, it's too late. So as central banks more aggressively cut rates, that's just a sign that the economy has deteriorated so far. Exactly what I said on July 3rd. And so you look at recession history, and it's always the same thing. The recession starts and the rate cuts start nearly simultaneously, but usually with a little bit of a lag. And it's not just the Federal Reserve. The ECB, for example, back in the 2011-2012 recession that nobody saw coming. In fact, the ECB was more worried about inflation. Sound familiar? The ECB cut rates November 9th, 2011. And then they cut rates again on December 14th, and then again on July 11th of 2012. The recession of 2011-2012 began during that same fourth quarter where the ECB started cutting rates. So they started cutting rates after the recession had already begun. So the rate cuts were nothing more than confirmation the weakness had arrived. The US, the Federal Reserve. The Federal Reserve began cutting rates in September of 2007 with a 50 basis point rate cut, which is pretty much standard for the Fed, at least in its 21st century version. So they cut rates in September 2007. The Great Not Recession begins 2 months later. And then, of course, there's more rate cuts that follow because unemployment in the economy falls off, unemployment rises. And even though most people wouldn't get the sense that it really was a recession until the middle of 2008, the Fed kept following with more and more rate cuts because they don't do anything. Same thing in 2001. Alan Greenspan's Fed started cutting rates in January 2001, 2 months before the dot-com recession officially began. And then 1990, the S&L recession, Greenspan again started cutting rates in July of 1990, the same month the recession started. And he really didn't start cutting rates more assertively in more sustained fashion until October of 1990. By then, the recession was already firmly in hand. So the central banks are just a confirmation that the recession has arrived. When the weakness gets to be so weak, the economy deteriorates so much that even the Fed or the ECB or Bank of Sweden, Riksbank, or anybody else can see it, it's already too late. That's the whole thing about rate cuts. So when I said in early July that a July rate cut was likely in play, it seemed preposterous. Now, most people would agree that it doesn't seem preposterous at all. Well, even though many people might not think that there is a recession, it's still just a risk, the evidence continues to pile up, including panicky central bankers, that it's already happening. And we continue to see these inflections. With more time and better perspective, more hindsight, we can see the economy falling off last year, which is understandable why people missed this, because remember GDP in the third quarter of the United States, we had this 5% surge. When the labor data suggests that at that very time the GDP was surging, everything was already turning down on this way toward recession. Even the QCEW payroll numbers suggest July of last year as the initial inflection. And then there was a secondary reflection. That initial reflection reflected an economy moving into a half recession state, characterized largely by the hiring freeze, as well as manufacturing difficulties, and a goods economy recession that you could see in the GDP numbers. But then March and April, things began to change again for a couple of reasons. Probably because of the imposition of insurance costs that surged at the early part of the year, which consumers just could not afford. Gasoline prices, energy prices surged again. The cure for high prices is always high prices. Demand destruction that showed up earlier in the year. And then the economy got destroyed enough around March and April. And now we see it in any number of ways, from quantitative indicators to the data to corporate warnings and, of course, the marketplace. And even now, the final piece of the puzzle, rate cuts from panicky central bankers who realize they're behind the times yet again. If you want to see what I was talking about in that video from July 3rd, that's the one I've got linked below. There was a lot in there that suggested exactly where we are today. As always, I thank you very much for joining me. Huge thank you, Eurodollar University members and Eurodollar University subscribers. And until next time, take care.